Okay, so good evening, everyone. My name is Santos Morales, and I'm one of the business consultants at Suffolk County Community College, the Entrepreneurship Assistance Center. And welcome to this second part of webinar on budgeting and sales. So this is the second part of planning for profitability. The first part was on costing and pricing, and that was done at the beginning of August. I believe there's a recording of that you can access on our on the center's YouTube page. This will also be posted on the YouTube page for those of you that want to watch both of the webinars. And I will recommend that you do watch the first one, which is costing and pricing, because today we're going to do a recap of that, but we're also going to use some of the numbers in terms of sales projection based on the exercise that I did on the first part of the series of this planning for profitability. Okay, so welcome everybody, and we will get started. So as I mentioned, we had, this is the second of two workshops on planning for profitability. Previously, we talked about pricing. Okay, and this is probably one of my favorite topics, pricing, costing, budgeting, sales forecasting, all of this, because it really is the bloodline of the business, right? When it comes to profitability, we need to have a really good understanding of what all of these expenses, all these costs mean to us as business owners, so that we can then plan accordingly in terms of our marketing campaign, as well as we can project our sales revenue, right? So previously we talked about pricing. And what is pricing? So to recap, pricing is basically the amount that you will charge a customer, right? And the customer will pay for your product or service. And the goal in pricing is to mark up the cost associated with that product sufficiently enough to cover all your expenses and to generate some profit, okay? So that is the goal. Pricing is what you charge customers for what you have to offer. That's what they'll pay, right? The objective in pricing or in the pricing process should be to reflect the company's marketing, financial, strategic, and product goals, as well as the consumer price expectations and the levels of available stock and production resources. So that sounds like a mouthful, but again, the objective is to be able to reflect all of your objectives in terms of marketing and financial and your strategic plan, right? But it also has to do with the understanding what people are willing to pay in the market, right, for what you have to offer. So knowing the difference between cost and value can increase your profitability for the business, right? So the cost of your product or service is the amount that you spend to produce it. However, the value is what your customers believe the product or service is worth to them. And that's really important. If you know that your customers value the product or service that you have to offer, then you could actually set a premium price, right, for your product. And that gives you some sort of competitive advantage based on the value that people place. Now, there are certain things that influence pricing, right? So it's not like we could just go out there and charge, whatever we want, right? For things, there's things that are already established, like the sensitivity in the marketplace, which is basically changes in consumer demand as price changes. Also, the quality of service and the uniqueness of what you have to offer can also influence the sensitivity in the marketplace. That's one of the influencers. The other influencer is the level of demand, right? Basically, how great is the demand for the type of product that you have, right? The higher the demand for your product, the higher you can price your products and services. Another influencer is your competition. So obviously, we have to be mindful of what others are doing in the same space that we are when we're selling something, right? When we're in business. And so the less competition you have, the higher the demand there will be for your product. But if you have a lot of competition, then that means that you may have to be a little bit more price conscious, right? Because then people will have a lot more options. The other thing that influences price is government regulations, right? And so that's important to know because government can tell you, as a business, that you cannot charge X number, or a percentage. You cannot gouge on pricing when there's an emergency. So government regulations is also an influence of the pricing. So those are 4 different influencers: the sensitivity in the market, the demand, right? The level of demand, the level of competition, and government regulations. Now, there are some factors to pricing, right? So you should know, and this is something that we discussed during the previous webinar on costing and pricing. Some factors to pricing include the cost of production, right? And we know that there are fixed costs that we have to be aware of, like our rent, right? Salaries, things like that. And then there are variable costs like materials, labor, right? Shipping supplies. Those are variable. Another factor to price is the demand, right, for the product. And we already talked about that. If there's a high demand, then the price can be affected, right? You can charge more or less depending on the demand. The competing companies we mentioned already is another factor. Purchasing power of customers. If people have enough money or disposable incomes, right, then they're most likely to, buy sometimes at higher prices. So the purchasing power of customers, it's really important. It's an important factor to pricing. As we discussed already, government regulations. The other factor has to do with your company, right? So what is your company's objective in terms of how do you want to be perceived or looked at, right, in the marketplace? So just because there's a lot of companies doing the same thing or similar thing doesn't mean that you have to price like them, right? If there is a competitive advantage in terms of maybe a unique selling proposition that you have with your product and added value, then and that's incorporated as part of your company's objective, then obviously that's going to influence, right, the pricing objective that you're going to set. And also the marketing methods that you use are going to be another factors for pricing. Why? Because marketing campaigns are meant to entice people. And so when you create your marketing campaign, you're basically going to tell people, hey, this is my company. These are the prices that I have, for these products. These are the products that I have, and these are the pricing. This is the pricing strategy that I have. And talking about pricing strategy, we talked about 4 different pricing strategies during the first workshop. One is premium pricing. Basically, this is when you have high-priced goods, right? The name itself suggests that you're selling something premium, right? Something, that not everybody can make. Or it has a special attribute to it, right? Something unique to it that other people cannot match. So that's premium pricing. There's also penetration pricing. By the way, an example of a premium pricing strategy is, for example, high-end designers, Dolce & Gabbana, Gucci, Versace, all of these companies, right? They price Coach, they price their products at premium pricing, right? Because they stand out in terms of quality, in terms of design, in terms of what they do. So they have a high price good and they use a premium pricing strategy. Penetration pricing is when your price is low at the beginning, but then you begin to increase your prices. Now, why would you do that? Well, if you're new to the market and you want to gain market share, right? You want to get some of those dollars from customers that are buying from other companies, you may want to consider a penetration type of strategy where you're going to introduce your product and you're going to say, here's an introductory price. This normally costs $100, but today or this weekend, right, or for the next few weeks, you're going to be able to get this product for $50 instead of $100, right? So you lower that price when you're trying to penetrate in the market, when you're trying to gain market share. But as you gain, right, market share, the price begins to adjust to its intended price, right, to its intended goal. Let's see, economy pricing is when all the prices are usually set low all the time. And a good example of this is, for example, Walmart, right? So Walmart, they cater to economies of scales, right? Just like Target and the big department stores that sell, on the lower end of pricing. So usually they set low prices because they're able to buy in large quantities from distributors or manufacturers. So if you're employing this type of strategy for your business, you should have a really strong backbone in terms of production, manufacturing, ordering. You're going to have to order large quantities so that the price or the cost of what you're selling, the cost of what you're buying, which you intend to sell later, can be low enough so that you can still make a profit, okay? And then there's also price skimming, which is when the prices are high, but then over time they lower, right? And this is sort of like the opposite of penetration pricing. So an example of price skimming is, I can tell you, like, for example, game consoles, Sony, even cell phone companies that make, cell phones like Apple, Samsung, they use price skimming. When the first model of the iPhone comes out, it's extremely expensive, right? They tell you, it has all of these bells and whistles, but 6 months later, based on how consumers are purchasing the product, they begin to lower the price. The same thing happens with game consoles, right? Like Sony and the likes basically will have a high price on their PlayStations, right? So that people, have this urgency. Oh, I need to have it. I need to have it right now. I want to be the first one in my family or in my neighborhood to have it. And they pay that premium price, right? They pay that high price. But 6 months, 9 months later, you can go to the store and buy the same thing for lower than originally sold. So these are 4 pricing strategies that you can use depending on your business model, depending on what you're selling, depending on your ability to purchase, right? Depending on the cost of your product. You can use any of this. You can use a combination of them, or you can use just one. And these are 4 of maybe 8 or 10 different types of strategies in pricing. So again, I'm not going to go through all of them. I wanted to highlight 4 that we had discussed before. Let's see. So let's talk a little bit again about cost, right? And the reason why I wanted to do a quick recap today before we talk about and we delve more into the budget and the sales projection is because it's important for you to understand that your budget and your sales projection all rely on understanding cost and pricing, okay? Understanding your expenses. So a cost is the value of money, right? That has been used to produce something. So there's direct cost, which is usually attributed to the production, right, of specific goods or services like labor, raw materials, commissions, supplies, etc. Then there's indirect costs, which is like overhead expenses, rent, utility, insurance, administrative expenses. These costs are not necessarily associated with the production of what you're selling, but they are important to keep your business in operation, right? So, and you have to, you have to pay them, right? You have to pay rent, you have to pay utilities if you're going to have this business going. And so this is sort of like there's costs that are directly related to what you're selling, and then there's costs that are indirectly related but are necessary to do business. There's also fixed costs and variable costs. So a fixed cost, for example, is an expense that does not change with an increase or decrease in the number of goods that you sell or produce, right? So no matter how many widgets you sell, these expenses are going to be the same, right? And an example of that is rent, right? Whether you sell one widget or 1,000 widgets, you still have to pay rent. And so that's sort of an example of what a fixed cost is. Then there's variable cost, which is the expenses that changes in proportion to the production output. In other words, these costs basically can increase or decrease based on the volume of sales that you may have. Okay, very, very important to understand the difference between these and the importance of how they relate to sales and budgeting. The next thing you need to understand really, really good, okay, and this is where you will need to take some time, probably the part of the finances that most people stray away from because they don't want to face this exercise of understanding how much, they may be scared or have a fear of, will I be able to make it, right? And it's so important that you, as a business owner, understand what is your break even. That's so important. Just because you are generating sales does not mean that you are generating a profit. And that's a mistake that a lot of entrepreneurs and even seasoned business owners tend to make. Just because you made $10,000 this month doesn't mean that you actually made a profit, because you need to understand, what did it take for you to make that $10,000? Once you do, then you can say, okay, all of these expenses were, all of my expenses, direct, indirect, fixed and variable were $9,000, and I have $1,000 left over. So now you can say I made some profit, right? But in order for you to get there, you have to do some calculations, and that's what the break even is for. And it's really important for you as a business owner to be able to understand it and to do it. Okay, so again, profit is what? The financial benefit. We like that, right? We want that. We want to make sure that we're in business to make profit, right? If you're in business and you're giving your product away, hey, you're running a charity, you're not in business, right? You might as well just open a nonprofit and do some good, some social good. If you're in business, it's because you want to make money, right? But more importantly, you want to make a profit. And that's the key. So that's the financial benefit that you realize when the amount of revenues that you gain through the business activities, they exceed the expenses of your business, okay? One thing that you can do as a business owner is to increase your profits. Is to look at your costs and see if you can decrease the cost of doing business, or even the cost of goods sold, right? The fixed and the variable. Look at those if you want to increase your profit margins. Now, the break even, which is extremely important, I would say this is probably more important than the profit, because if you don't understand how you put it all together, you're not going to know that you are making a profit, or whether you're making a profit or not. So this is really key. A break even is a way to identify the minimum level of sales, right, in units and dollars that you are required to cover for all your budgeted expenses. In other words, your business's break even point is the volume of sales at which the revenues and the expenses meet, right, where they're equal. You don't make a profit at the break-even point, but you at least have generated enough revenue to cover your expenses. My advice has always been, when you start the business, strive to break even first. Once you have done that, then you can you have gained some, I guess, some taste for what money is, and then you can really put your efforts into making a profit. Excuse me. So again, understanding the break-even analysis, the break-even point is extremely crucial. Now, this is a sample of the exercise that we did during the first workshop. And basically what we did was we tried to figure out what was the break-even point for this canvas business, right? And we have said that we're gonna sell these bags, excuse me, we're gonna sell these bags, these tote canvas bags for $10, right? And we knew that we had variable expenses and that we have fixed expenses. And these variable expenses were related to like raw material, labor, commission, shipping, right? This is what we call the cost of goods sold, right? And then we knew that we also had certain fixed expenses that were indirect costs to the business, like rent, telephone, insurance, a loan that we had to pay, and some bookkeeping fees. And then we knew what these were right away, right? The fixed expenses, we knew what they were, but we had to do a little bit of a calculation to figure out what were the costs of variable expenses. And when we did that, we were able to see that for variable expenses, we needed $5.50 per bag, right? And then we knew that that $5.50 is the total cost. And then we had from each sale, which was $10 per bag, we knew that we had a balance of $4.50. Basically, you sell one bag at $10, the cost of that bag was $5.50, and the leftover money, the $4.50, is what we call our contribution margin. It is the amount of money that we have to contribute to all of the fixed expenses, okay? So after we did this exercise, we realized that to pay for all of our expenses, fixed and variables, we needed to sell 300 bags per month, right? And basically the way we did that is we, to find out how many bags we needed to sell, we divided the total monthly expenses, which was $13.50, by our contribution margin, what we had left over after we paid for that bag, right? For the manufacturing of that bag. Once again, $10 a bag, it cost us $5.50. We have a $4.50 left over, which we are calling the contribution margin. And that's the amount left that we have to pay for all of the rest of the expenses. We knew that the expenses were $1,350. So we took that amount and divided that amount by the $4.50, since we already had covered the cost of production of the bag. And that number came out to 300. And then when you do the math, you'll see, let me see if it's on the other one. Well, you'll see it in a few, but you'll see that when you sell 300 bags at $10, that gives you $3,000 of sales revenue, right? So those are your revenue, $3,000. From that $3,000, you're gonna need $1,650 to pay for your variable expenses. And how we arrived at that $1,650 is multiplying $5.50, which is your total cost, by the 300 bags that we're gonna sell, right? How we got the 300 bags is we took the total fixed expenses, which was 1,350, and we divided that by our contribution margin, which is $4.50, and we arrived at 300. So that's really important. You need to be able to do this for your business. You need to calculate all of your expenses. This, by the way, is a very simple exercise, but hopefully clear enough for you to understand how to do a break-even point, right? But you need to do this for your own business, whether you're selling, widgets, or whether you're selling a service, a consulting service, a bookkeeping service, whatever it is that you're selling, you have to do the same analysis. You have to figure out, based on all of your expenses, how many units you're going to need to sell. Okay, hopefully everyone is clear. If you are unclear, please rewind this tape, this video recording. Gosh, I said tape. That's kind of like really old. So that tells you that should tell you my age. So basically, you will just go back a little bit and try to again listen to how you calculate all of this. And the first workshop or the webinar on this actually goes into a lot of the details of how we arrived at these numbers. But once again, before I move over to summarize, to get our break-even point, what we want to do is we want to figure out what are our variable expenses in terms of the cost of goods sold. Now, you're going to hear that word, cost of goods sold, that term, right? Many times over in your business, right? And they actually spell it out, COGS, cost of goods sold, COGS. They call it COGS, right? And you have to figure out what your COGS are for your business. Once you have that, you also have to figure out what are your expenses for the month, those fixed expenses that are indirectly related to, the production of, your COGS, your cost of goods sold. And you take those two and you're going to do some basic math. You're going to need to know the price. That's why we talked about pricing, right? Because it's important for you to know how much you're going to charge people. Let's say if you were selling this bottle, right? And remember, there's a difference between selling this bottle at the stadium, selling this bottle in the middle of the desert, and selling this bottle at the beach. The same is true for selling this bottle of water at the club, right? Or at a restaurant, or if you're in a corner store selling groceries, the price is different. Why? Because the value that people place on that bottle of water based on their circumstances will be different each time. Obviously, if you're at the grocery store, you may charge what, $2 for it, right? People come in and out, they grab things. Oh, let me grab a bottle of water. If you're at the stadium, however, you may end up paying $4, $5 for it, right? Why? Because there's no grocery store there. And so the price usually is gauged, right? It's higher. If you're in the middle of the desert, obviously you're going to pay a lot more than $4. If you're in a situation where you're thirsty and you haven't had any liquids or water, you're going to pay more. So again, the value, I just want to emphasize the value that people place on your product or the product or service that you sell is going to determine the price that you're going to charge. Once you know that price and once you have set the price for your product, then you can use that number to deduct your variable expenses, and whatever is left over, then you're going to use that to figure out what is the number of units that you need to sell from that bottle of water to be able to pay for all of your expenses. I know it sounds a little confusing, maybe too riddly, but trust me, if you do the exercise, if you look at the numbers that I have in front of me, which you see as well, try to follow this because it is a simple format, right? I don't want you to do something that has thousands of dollars, 10, 20, 30 thousands of dollars, even if that may be the case for your business. At least try to understand this basic exercise, because these are small numbers. We can all relate to paying maybe $800,000-$900,000 in rent, and these numbers are very small. You can use that, you use the price, and then you find out what is the cost and your contribution margin, and then you can, figure out from there how many units you need to sell. Okay. So hopefully I haven't bored you with this information, but it is crucial. It is extremely important that you understand these things, because we're going to go into creating a budget and preparing sales projections. So you need to know this stuff. Okay, so very quickly, what is a budget, right? So budgeting is establishing a planned level of expenditures. Now, keyword here is planned, right? We don't just like put numbers because. We put numbers together because we have a plan, right? So if you're watching this video, you probably have been working on your business plan. You're probably a graduate or an alumni or a current student of the Entrepreneurship Assistance Center, and you're probably at that crossroad where you need to figure out how to put these numbers together, how to put your financials, how to put your forecast together, how to do your break even, your planning. That's the key word. So when you think about budgeting, think about you're creating a plan of what? Expenditures, of things that you have to spend money on. Okay, the most effective financial budget includes both a short range and month-to-month plan for at least one calendar year and a long range quarter-to-quarter plan that you can use for your financial statement reporting. What that basically means is that to be successful in this and to be effective, you want to do two types of budget. The first budget, you're going to do short range, right? You're going to do one maybe that does a month to month. You work on your budget for the month of September, right? What are your expenses? What are the planned level of activities that you're going to have? You're going to write that all down. But that's not going to be enough for you, to know whether you will be profitable or not at the end of the year, right? Or maybe 2 years from now. And so what you want to do is create a second type of budget that plans on the long term. Now, there are a number of different types of budgets, okay? So please know. So if you're buying any supplies, materials, anything that you're gonna use to manufacture, create your product, you're gonna have to create a budget, right? So that basically means that you're gonna have to figure out how much supplies, materials, labor, etc. you're gonna need so that you can put together this wonderful product or service that you have to offer. And that entails some calculations. So once again, I encourage you to become friendly and familiar with these terms and these exercises. The more you do them, the better it will be for you to, feel comfortable with the numbers. Okay, so let's go. So let me tell you a little bit about the uses of budgets. So why are budgets important, right? What are the uses? Well, budgets guide purchasing powers, right? So when we have a list of things that we want to buy, then that basically dictates how much we're going to spend. That's just what that is, right? That's what budgets are supposed to do. Guide our purchasing powers. It helps us to schedule things as well. It helps us to market, or at least in the marketing campaign. It helps us for financial activities as well as personnel activities. Why? Because you want to be able to have a detailed level of understanding of what and where and how you're spending your money. Okay, so they are guides, they're not controls. So I want you to know the difference. A guide is going to do what? Give you sort of like that path, right? It's going to create the scenario for you. A control is going to manipulate that path. And I don't want you to think of a budget as something that controls you, because it shouldn't, right? You should be able to, at some point, have control of your budget. But you should be able to create your budget in a way that helps guide your business activities, because you need to understand what all of those activities are, right? And so you can't say, well, I'm only going to put $5,000 on my budget if you don't know what all the planned activities are. And if you don't even know if that $5,000 is going to be too much or too little. Okay, so again, budgets are meant to guide you, not control you. But you will have to develop at some point some control over your budget so that you're not spending erratically and fanatically and crazy, and then you lose all your money. So there's a difference though, okay? So budgets involve educated guesswork, not accuracy. And why I say this is because some people get fixed on saying, well, yeah, it has to be to the penny. Yeah, well, I mean, you'll get to that point eventually where you're going to go down through the financial report and you'll look at the pennies too. But for now, I want you to know that we're going to make some educated guesswork, okay? So it doesn't have to be perfect, but it has to be clear enough to guide what we're doing. Why we use a budget is because it helps us understand, evaluate, and conduct additional planning when we deviate from what we set out to do. So if we said, okay, we're gonna, do A, B, C, and at the end of the month we realize that, we didn't do A, B, C, we did D, E, F, then we need to know why did we deviate? Why did we take the other path, right? So when you deviate from the budget, you must evaluate the result of that budget, right? And you must conduct additional planning, and you also must be flexible and adjust your forecast. And one thing is you have to act, right? You have to take action. If you know that you need more money, maybe you underestimated some things, then adjust what you're doing so that you can, be profitable and not have issues with your budget later. Budget offers opportunities for reducing cost, right? And it helps improve our products, and it also increase our efficiency, because once we know how to make a budget, guess what? We're going to use it all the time. So if you're like me, kind of a bit of a nerd for numbers, and I've honestly, I've developed this over the years, because at first, like no one really grows up saying, I want to do budgets, right? That's not something that people don't, they're not born with that. They develop a passion for it, right? Over the years. So, and this is the same thing for you. You can do this and use it on your own personal. If you don't have a business or you don't have a business yet, then you can use this for your own this information you can use for your own personal good, right? So it offers opportunities. It draws attention also from the daily routine of doing work and focuses your attention on how the work is getting done. Budgets are good to communicate plans and goals, okay? It is a planning tools. It helps identify your variances and deviations. It helps to communicate your goals. It encourages good behavior when you do your budgets, right? Because you'll be doing it over and over. And I promise you, once you get into the swing of doing your budget, you're going to like it, because you're going to want to see, okay, where is my money going? And again, you want to identify those areas, right? You want to evaluate those results so that you can make actual profit, right? You can cut in there 3, 4, 5 times a week or a month, right? It's enlightening to see your bank statement report. And I encourage you to do that, download them, print them out, look at them physically, right? So that you can get a hold of understanding where your finances are, understanding where you're spending money, and how easy, as we all know, money goes, right? Budgeting encourages good behavior, and it's also responsibility accounting, encourages responsibility accounting. Basically, it holds us accountable to be responsible, okay? So moving on, what makes a good budget? So we already talked about why all of these reasons we should have a budget, right? But what makes a good budget is involvement. Every person in your business should be involved in the process of the budget. And then, I mean, obviously there might be some things that you want to keep for yourself, like salaries, right? So if you have multiple people working for you and they'll make different salaries or hourly rates, then you don't want to disclose that for you as a business owner. But when you are planning, when you're in that planning stage, then you want to get everyone involved, right? Why do you want to do that? Because you want to show them, right? You want to include them because you want them to see that it takes money to make money and that their contribution in that business is important for their business success and their own salaries. And so that's one of the reasons why you want to show the budget and share the budget with those people that work with you. So involvement makes a good budget. The consistent use of the budget is also another good behavior, right? Basically, you're going to do it, you're going to review it, you're going to evaluate it, you're going to do it again next month and next week, and you're going to get into that practice to make some habits of consistently looking at your budget. Also, it helps to document your assumptions. So obviously budgets are, as we said before, educated guesswork. And so we want to be able to document those guesses, right? Those estimates, so that when something goes, south, north, wherever you point at, when things don't go right, then you can look at the assumptions. Well, wait a minute, I said I was going to spend this much and I ended up spending this much. What happened, right? So a good budget will help you, look at the assumptions that you've made. What makes a good budget? The ease of use. There's a number of computerized programs that you can use. You can hire an accountant or bookkeeper to do it, but do it. Somehow you have to get involved in doing it yourself and understanding. You don't have to be an expert, so don't get me wrong. For those of you that only want to touch the budget with your fingers, that's fine too, but you must understand these numbers. Why? Because even if you hire someone and that person is a CPA, right, a certified public accountant with credentials, like a lawyer, right, a lawyer for numbers, you still want to be able to understand what those numbers mean, what those reports mean. You want to understand how your money is coming and going. So you don't have to be an expert, but you definitely want to understand, how these budgets, how these numbers come together, and you want to understand whether you're making money or not. A good budget is integrated, basically fits the needs of your business. A good budget begins with a forecast. So that's really important, right? That we can do those guesswork, those estimate, and then we can put it into some sort of, the estimate is some sort of, there's a word for it that is escaping my mind right now, but you can use it for your forecast, your estimation. Make sure you don't inflate your numbers. Be conservative, but not too conservative that you're not going to be allocating enough resources for the needs of your business, right? So I always tell people be conservative because there's no point in, just spend. You have to have some level of control over the budget, right? As it guides your decisions, right? As you're planning for it, but don't inflate them and don't be too conservative. Try not to start with a negative cash position, which a lot of businesses do. So that's why it's important to do a good budget. That's why it's important to know your numbers. That's why it's important to do your break even, because you don't want to start with a negative. What does that mean? Starting a negative means that you budgeted for 5,000, but money didn't come in, and now you only got 4,000, and you're like $1,000 short at the end of the month, right? So technically, you're not short because you will have paid that $1,000 with something, whether it's with money that you have in the bank from your own savings, or whether you use the credit card to pay for it. It doesn't matter, but it is a negative, right? It's a red. It's a negative cash position. You don't want that. That's why it's important to know these things. So account for every, account for every dollar coming in and every dollar going out. One of the things that I appreciate so much from one of my uncles who's already passed, my Uncle David, he will take a notebook, right? He had a little notepad that he always carried in his front pocket. Anytime we will go out, anytime, and he will go to the store or anywhere. Anytime he bought something, he actually took the little notebook and his pencil and wrote in there, purchase milk. He bought, he put a description, and that was sort of his ledger, right? That was sort of his way of keeping track of his money. And so most of 30, 40 years ago, we didn't have all these computers, all this technology. And so my uncles who, he's passed now, but many of my older uncles who are in their 70s, 80s, obviously they didn't have. So that was their way of keeping track of money. And I so appreciate that because it really gave me a sense of, since I was young, it gave me a sense of, what to expect and not expect, right? What do I do if I come in contact with money? How do I account for that responsibly? I'm not saying that you should do that, but if that makes sense for you, do it. Do it. But we have so many tools available. Technology has come a long, long way, and so there's so many things that you can use from using this from your phone, that you can download different programs and keep track of all your money. If you have a bank account, and you should have a bank account for yourself and for your business, you should be able to, with the same bank, try to consolidate into some sort of bookkeeping, keep track of your expenses, etc. But make sure that you account for every dollar coming in and every dollar coming out. Make sure that you establish a system of recording your sales, right? The income that is coming in, to create a historical report. Why this is important? Because you want to know when you did well, right? When did you make the most money? If you're not keeping track of sales, right, of the money, then you won't be able to look at history. You won't be able to look at data. And that's really important. You'll be able to, if you're keeping a record of all your income, right, of your sales revenue, then you'll be able to see, based on your income, based on the money coming in and based on the money coming out, when were your good months and when were your not so good months, okay? Okay, so let's see. I know I'm running short. I'm going to try to speed it up. Learn from budgets, compare the projected, right? When you create your budget, compare that to what actually happens, okay, to the actual. And then try to understand, what does it say to you, right? If you had budgeted $5,000 and you're looking at the actual expenses, the actual report of money coming in and money coming out, and you're saying, okay, I initially planned for $5,000, but now I see that my revenue is $4,000. So where did I go wrong, right? What happened? I need to understand that, right? And so you want to, again, compare. What happens when there are variances or deviations from your budget? Well, you want to evaluate the result, at least try to ask yourself, and learn from it, right? You want to conduct additional planning. You want to adjust your forecast. If you've noticed a pattern, then address it, right? If you see that sales are continuously low for a period of time, then you have to go back to your budget and your sales forecast budget to adjust so that you're not going to be, so that you're not in the red, continuously. And then you may have to look at what factors are there, if there's anything that you can change, right? Sometimes, it could be that maybe you have too much staffing. Maybe you're buying from a supplier that is charging way too much money for what you use. So you want to be able to conduct additional planning, adjust your forecast, and take action, okay? Don't leave things like that. Here's your budgeting cost of goods sold, COGS. So this is based on the exercise that we did last week and I mentioned earlier. So raw materials were $3. So we needed to sell 300, right? So 300 units times $3 for raw materials is $900. That's your budget, right? Your hourly labor came out to $1. You need to sell 300, so 1 times 300 is 300. The same thing with your commission and the same thing with your shipping. So basically what you're doing is looking at the per unit cost so that you can budget for the entire month. Right? That's what this means. Any of these numbers here, the low numbers, 31150, right? Altogether, that adds up to 550. So when you multiply any of these to the units that you have to sell, that's where you get these numbers. 550 times 300 is 1,650. This is another small budget of your monthly expenses. This is again based on this exercise that we did with the canvas, where we're looking at rent fixed, right? All the time you're going to pay the same amount of rent, no matter whether you sell 1 canvas or 1,000 canvas tote bags during the month. So these expenses are fixed and they don't change. And then this is basically a sample break even, which is what we've been talking about. So we know that the sales revenue is $3,000 because when you take 300 units, right, at $10 a piece, you're selling them at $10, and you know that you have to sell 300, then that's a $3,000 sales revenue, right? These are your sales. And we already have the raw material, the 900, 300, we got that from here, right? Multiplying the unit cost times the number of units that we have to sell. And so that's what you see here in terms of cost. And then you have your monthly expenses, they don't change. They're basically these here, right? Your rent, your telephone. So this is another way of putting those smaller budget into one bigger budget. And this one shows you the monthly income of 3,000, cost of goods sold 1,650, and monthly expenses of 1,350. So when you look at this, how much is your net income? Basically, what you have left over, 0. So you have basically in this example, you have done your break even. You know you need to sell 300 units at $10 to be able to cover for all of this, all right? So if you sell 330 units, right, at $10, then that will be, let's see, 330 times 10, that's $3,300. So then this amount will increase by $300 in terms of revenue, right? But what else will increase? The cost of goods sold, and it will increase. So it's 330, we're selling 30 more, right? So 30 more, and so 30 units times $5.50, which is the cost, that's $165 more. So if we are doing 30 units more, right? We're not breaking even anymore. We sold 330 units instead of 300. That 30 additional units that we sold generated $300. And from that $300, we have to pay $165 for what? For the raw materials, right? And so then we have a little bit of money left over. Okay. This is just a sample of that. Hopefully you'll understand it. You can also call us, we'll make an appointment if you want us to help you create or develop or design or put together your break-even analysis. So let's talk a little bit about sales forecast. So how to do a sales forecast, because a lot of people say, well, how do I know? I've had this question asked many times. Santos, how am I going to do my projection if I don't know what I'm going to sell? Right. So obviously, no one really knows if you're going to sell anything. Being in business is not a guarantee to make money, right? It doesn't guarantee anything. You could spend $1 million in launching a business and go bankrupt in a month or in a week, right? It doesn't guarantee anything, but you have to do some estimation. You have to do some educated guesswork. So the sales forecasting is the process of predicting, that was the word, predicting the future sales of your business. So that's what you are doing when you are forecasting. You're predicting the future sales of your business. First thing to know, all your expenses. Know all your expenses. I can't emphasize that enough. I've said it on the first workshop. I've said it again, maybe 10 times already during this workshop. Know all your expenses. Know what the fixed, what the variable, what the direct and the indirect are, okay, for your business. It's really, really important. Second, know your break-even point, right? You're going to need to know the expenses and the costs associated with the business for you to get your break-even point. Okay, and that basically is telling you how many units you need to sell to cover your expenses. All right, that's the starting point to your sales projection. Until you do this exercise, you are not able to do sales forecast. Okay, you have to. The third thing is project, right? Do your sales projections based on your expenses and your break even. And then begin to monitor your sales very carefully, right? Is the money coming in? Am I selling the number of units I said I was going to sell? So if we had, in this example, um, we had to sell 300 units of these tote bags, right? And if we're open 30 days in a month, that means that every day we have to sell 10 tote bags, right? Every day. If we are only open, let's say Monday to Friday or 5 days a week, so that's 20. So let's say 300 divided by 20, that means we have to sell every day that we're open for business 15 tote bags. And that's, again, knowing those numbers and those figures, that's going to help you incredibly to really, monitor what you're doing, monitor the sales. You should definitely use sales forecasting as a goal setting, right? That's without a doubt. Forecasting as a goal. So forecasting helps you set your company's financial goal. Basically, you're going to be answering, how much sales am I going to achieve in this month and the next month, right? Or over the next few months, over the rest of the year, over the next 5 years. Forecasting as a goal is going to help you answer that. It's also going to help you answer the number of people that are going to buy from you, right? In this case, if we need to sell 300 totes, we are going to assume 300 people, but there might be a few people that buy more than one, right? I'm usually the kind of customer, maybe that's not such a good thing, but I'm usually the kind of customer, if I like something, I will buy more than one of it for me and to give to someone else. Sometimes I just want two of the same, like maybe I have the shirt, but they have it in 3 different colors, and I really, really like the shirt. So I buy it in all 3 different colors, right? So in this case, one customer purchases 3 items, but you can use that assumption all the time, but you can break down the assumptions later. I'm not going to get into that because that, that's may confuse you a little bit more, but if you are confused, but hopefully you're not, and you're following this, but you could set a percentage of your sales to be multiple buyers, multiple units per buyer. But in any case, this will help you answer the amount that each customer will spend, and it also helps answer investors' questions about your business. So let's say that you have this business and you happen to run into Santos and at this webinar, and Santos becomes really interested in this tote bag business because he also has connections, right, somewhere else, and he could see this type of product being sold somewhere else and making money, and he decides, you know what, I'm going to invest with you, right? And so, and you see this pretty much from this TV show called Shark Tank, right? Where the sharks, the investors, buy into a percentage of the person's company, and then they funnel money, right? They invest some of their own money and resources and connections to expand the sales and the reach of that company. So again, forecasting is important as a goal because it helps with investors' questions about your business. One more thing, it's important that you understand how marketing and sales forecasting is related. Okay, this is all related. Once you have a good idea of what your financial goals are, right? Because we're using our sales forecasting as a goal setting, right? We're going to use this as a goal setting. So once you have an idea what those goals are, then marketing can be a great tool to attract your customers. And that's why you need to understand this first before you do anything else. You can't create a marketing campaign if you don't know how many people you're going to reach. Right? You say, well, I want to reach as many as possible. Well, that's not a good number. right? As many as possible is not a number. And so that's why it's important for you to start here in terms of sales. So your marketing campaign should attract 100 times the number of customers that you need, okay? For example, if you plan to reach 300 people, then you need to market your company's product to at least what? 30,000 people. Use several mediums to market your business, like digital, social media. By the way, digital and social media are not the same. They are related, but they're not the same. For example, digital can be email marketing campaigns, right? Those constant contact emails that you get from a company when you subscribe. So that subscription that you can do through a social media page or through your website, that's a digital form of marketing, okay? And we won't talk about marketing because that's like my passion. I love doing the marketing workshop, only because it's all related to this, right? To money and sales. But use several mediums to market your business, like digital, social media, print, radio, TV. The more people see your ads, the higher the chances of getting people to buy into your business, obviously, right? So you want to be able to, sell. Now, this formula that I gave you, 300 people times 100, right? That doesn't mean that it's always like that, but that's sort of like a rule of thumb. If you are there are certain marketing and promotional events that you can do and participate that may get you the 300 units in one sitting, right? There are street fairs and markets, and there are conventions, and there are expos, and there's all kinds of things that you can do to generate that. But all of those things that you're going to do, you need to write them out, and you need to see how much that's going to cost you, and then you need to go back to this exercise of putting your budgets together and using that budget to determine how many units you need to sell, and it goes into a full circle. So hopefully I did not lose you. Once again, marketing and sales forecasting, I hope you see the importance and the relationship of this is extremely, extremely important. Here, what I did is I created a sample budget from like September through December, right? The next 4 months, using the same numbers from this exercise. So we already know, based on what we have learned so far, that we're going to need to sell 300 totes next month, right? And that's going to generate $3,000. We already know the raw materials for that month, right? We did this already. So that's 1,650. And we also know the monthly expenses, which is 1,350. When we do this, we know that our net income is zero. We don't make a profit, okay? So that's one thing that you should be able to do right away. The first month, like I said at the beginning, always strive to break even. But you're not going to stay there, because if you stay there, you're not in business. This is a hobby. You want to pass your break-even point. You want to go and make money, right? That profit. So the next month, over the next 3 months, actually, what I did is I increased sales by 10%. In October, instead of selling 300 tote bags, we're selling 330. In November, we're selling 10% more, so we're selling 363. In December, we're selling 399 bags, okay? And so each month, I increase the goal, right, the financial goal of this by 10%. Now, that doesn't mean that you have to do it like that. It's just, I did it like that to show you, as you're looking at this exercise, how your numbers are going to change over time from your sales revenue here, right? And also from your cost of goods sold. What doesn't change, if you notice, is if you go down here in terms of your monthly expenses. Your fixed expenses, your monthly expenses are the same, right? Because no matter if you sell 1,000 of these tote bags or 300, your rent is always going to be $800. And that's one of the things that you want to be able to see in a chart like this. And I did this with Excel, by the way. So relatively easy. I have a template that I can share with you. If you contact us at the college, I'll be more than happy to share the template. If you need a session, a business session to sort of like go through this exercise together, one-on-one for your business only, then call us, right? That's what we're here for. So this basically is a sales projection, right? Where we are looking at, you know, what we're going to sell for the next 4 months. Okay. And as you see, the first month, we are breaking even, we make no profit. But as we move forward by adding that 10%, sales, we're making a little bit of money, right? Not a lot of money, but we're making some. The idea is that you're going to adjust this according to what? Your planned activities. Like just increase it by 10%, right? That's 30% over the next 4 months. But it could be that you are doing other activities, right? You may be doing sales expo, you may be doing street fairs, you may be having a website, you may be doing presentations, you may be doing a number of things that together is going to generate a lot more than what I just presented here. But that's that's up to you, your business, and your planned activities. And you should plan, right? You should plan to make as much profit as possible when you are doing your sales projection. Why? Because sometimes things don't go as we plan. We know that, right? Life gets complicated sometimes. But if we are planning to make the most out of it, when we have some months where we are, sinking in terms of sales, at least we're not losing the whole battle, right? We've prepared and cushioned ourselves enough so that we can move forward and we can make a profit. And we want to go on vacation, right? We want to go on that, 3, 4, 7-day vacation cruise with the family or the boyfriend or, whoever. Maybe you want to buy grandma that one, gift. So you want to make the money. So you want to stay focused, okay? Whatever your goals are for your business or personally, make sure that you follow this. Make sure that you ask questions. There's nothing wrong with asking questions. This is really important. I want to thank you for listening. It is 8:15, so we took a few minutes over the hour. Thank you so much. And I do hope that you find this information helpful for yourself and that you, revisit the videos, this one and the one before, costing and pricing. And if you have questions, that's what we're here for. Okay. So thank you so much. If there are any questions, I could take them now. And if there's no question, then I will gladly turn it over to the folks at the EAC Center. I see Kenya, it's here, and I think Jay is here. So thank you so much. Jay, I think